Before we can understand what bonds are, we need to know what debt is. Debt is the amount of money owed from one party to another. Individuals may take on long-term debt for large purchases, such as a home in the form of a mortgage, cars for auto loans, and student debt. They may take on short-term debt for personal purchases, most commonly done through the use of a credit card. Governments may take on debt because they were unsuccessful in raising sufficient levels of tax revenue from the country or state. By borrowing, they receive more funding to undergo regional and national projects, such as improving education, healthcare, or unemployment benefits. Companies can decide to borrow money if they need instant cash injections into the business and aren't capable of selling illiquid assets. This funding can be used to finance new long-term projects or pay for short-term obligations, such as pay wages and salaries to employees. But this borrowing does come at a price, and that price is interest. Interest is the amount charged on debt by the creditor for the privilege of borrowing the money, commonly expressed as a percentage. Now we know about the basics of debt, let's take a look at bonds. If you enjoy what you hear today, please like the video to improve the YouTube algorithm, subscribe if you haven't yet done so, and comment if we've missed anything. According to Investopedia, a bond is a fixed income instrument that represents a loan made by an investor to a borrower, typically corporate or governmental. They come in different categories and with different characteristics. Here's a summary of the main types. Corporate bonds are those issued by companies as an alternative to taking on other forms of debt, such as a bank loan. Municipal bonds are issued by the state and municipalities. Government or treasury bonds are issued by the national government for the purpose of financing government spending. And agency bonds are issued by government-affiliated organisations which are backed but not guaranteed by the national government. So what are the main components? Well, the face value is the amount of money the bond will be worth when redeemed at its maturity date. The face value, or FV, serves as an indicator for the issuer to work out interest payments. The issue price is the value of the bond when originally issued to investors. The coupon is the amount that the issuer will pay to the investor on the face value of the bond, where the coupon rate is this expressed as a percentage. The maturity date is the date that the bond will mature, requiring the issuer to pay the investor the bond's face value. So if a company issues a 15-year bond at $100 face value to investors paying a coupon of $4 paid annually, over the 15-year period, the company will pay $4 every year for 15 years, and when the bond reaches its maturity date, the investor will receive their $100 back. The grade of the bond is given by a ratings agency that signifies the bond's credit quality. This involves the ability to pay interest and the principal on time, along with the financial stance of the issuer. They investigate solid, factual information, such as reviewing financial statements, and also looking for long-term forecasts of both micro and macroeconomic performance. Examples of rating agencies include Moody's and Standard & Poor's. They analyse fixed income securities, giving their versions of high-grade rated bonds down to the lower-grade, riskier alternatives. If we look at the chart taken from Investopedia, we can see the stronger rated bonds, AAA down to high B rated bonds, are called investment grade bonds. This translates to the bond being less speculative in terms of investors seeing a safer return of their money and a return on their money. Whereas junk grade bonds are those mid-rated B bonds down to C and D rated, showing a higher risk of the bond issuer defaulting as we move down the chart. So why should you be investing in bonds? Well, bonds are an asset class that can be added to a portfolio in an attempt to diversify. This means that you are not totally invested in the stock market. Bonds generally tend to perform better than stocks in down markets, showing uncorrelated returns. This can reduce the volatility of your returns and reduce the likelihood of losing a lot of money in a given period of time. Also, bonds are seen as a safer alternative to stocks. By investing in debt through bonds, debt holders have priority over shareholders when receiving payment from their investment. With Treasury bonds in particular, you are more likely to receive your principal and interest back compared to any other asset class, as the government has the option to increase taxes or raise alternative revenue in order to pay back Treasury holders. But there are some risks associated with owning bonds. One risk of owning a bond is that the value is vulnerable around changes to the interest rate. This is because if interest rates rise, issuers may offer a new bond at a higher interest rate. The higher interest rate becomes more attractive to bondholders, and they are more willing to pay for the better investment rate. As a result, the bond with the lower interest rate will have to be sold at a discount in order to become a considerable investment to current bondholders. Short-term bonds are less susceptible to this risk, as interest rates are less likely to dramatically change in the short term. However, over the long term, it is more likely that interest rates will change. This makes long-term bonds more risky, but in general, they generate greater returns as an investment over a longer period of time. Another would be the risk of the bond issuer defaulting, also known as default risk. This is more likely to happen to companies rather than governments or government bodies. If a company collapses, it is unable to pay back the value of the bond to its issuers. Therefore, the bondholder faces a loss on their investment. Government bonds are generally considered lower risk because they can raise more capital from tax revenues to pay investors. Now hopefully you understand what bonds are just a little bit more than before. This is just a summary, and I encourage you to undergo more research before investing in any fixed income assets. Please like the video to improve the YouTube algorithm, subscribe if you've not already done so, and if I've missed anything important, please let me know in the comments below. Thanks for watching.